Joining me now to kick things off, David Busch, Co-CIO of Trajan Wealth. David, nice to see you. So as we come into this morning's session here on Wall Street, the S&P 500 down 4 days in a row for the first time since February. What are you looking for in today's session?
Yeah, so it's interesting because, as you pointed out in your opening, is that Micron beat earnings estimates, and really what this is speaking to is what I call our second order thinking thesis, which is not necessarily chasing the hyperscalers and the large cap tech names that have been the massive beneficiary of the AI story, but looking down to that second level. So the AI infrastructure build out and those companies that are going to support that build out. And we saw the results of that in Micron yesterday. And so in my mind, it's the AI infrastructure story is alive and well.
Tech looking maybe a little bit vulnerable these last few days, but we are seeing rotation, healthcare, financials, industrials. Do you see this as a reason for optimism?
I do, because really what it's pointing to is a broadening of the market. Over the last several years, we've just heard about the Mag 7 stocks, and really, investors, if they just bought the Mag 7, they performed really well. But now we're seeing that broadening of the market. So those other sectors that are going to be beneficiaries of the AI infrastructure build out, as well as rotating into more defensive sectors like industrials, materials, consumer staples, healthcare, and so on, are catching a tailwind. And so I think it's healthy overall for the markets.
PCE 4.1%, core PCE coming in here, David, 3.4. How concerning was yesterday's inflation print, if at all?
It was as expected, and I think that's why we got the reaction that we did. I mean, look, core PCE is still well above the Fed's 2% target rate, and so with unemployment still at 4.3%, consumer spending is still healthy. Really, the focus of the Fed has to be to squash inflation, but as we see with the cessation of the war with Iran, the price of oil has come down quite a bit. I mean, this morning we were below $70 a barrel on West Texas Intermediate. So what that'll immediately cause is lower inflationary pressures across the economy. But having said that, core PCE excludes food and energy. So it's going to take a few months for these lower energy prices to permeate and naturally lower the rate of inflation.
David, I wonder from where you're positioned, what part of the broader inflation story is most likely to pressure consumer spending that for the most part so far has remained resilient?
Yeah, it's all energy. I mean, we all have felt the pain at the gas pump, and so with the higher energy prices that we saw earlier this year and throughout the war with Iran, those higher energy prices bleed into the rest of the economy, and they show up in the cost of goods and ultimately the cost of services. And so with consumers, it's really giving them some relief from those inflationary pressures. But most of us, I realize that the Fed looks at core, but the consumer feels the headline. And so from my seat, it's when that headline number starts to come down and the cost of goods starts to stabilize and we're not seeing an increase, and even if gasoline prices come down a bit, we'll start to see that relief wash over the consumer.
So we got the June jobs report on Thursday of next week. Of course, that's just a day after the ADP print. Do you think it's something that's likely to move the needle, or given that it's heading into a 3-day holiday weekend, maybe something investors just kind of say meh to and casually move on from?
Yeah, I think the numbers when they come in, they'll be somewhat uneventful, because we've already seen that the labor markets have been resilient throughout this year, and so even if we have a slight uptick in jobless claims or a slight increase in the unemployment rate, that's still not enough for the Fed to lower rates. So right now the Fed is focused squarely on inflation and bringing that inflation rate down back to the 2% level. And even if the unemployment rate comes up a little bit, they're going to be focused on inflation.
David, do you think stocks can continue to climb higher if interest rates stay higher for longer, as many are now expecting?
Well, I think they can, and the reason is because of the earnings growth potential, and that's really what we have to look at. And really, when I take a step back and look at the markets as a whole, really what this year has brought is a reversion back to focusing on the fundamentals, the free cash flow, the earnings growth. And if consumers are still spending, businesses are still investing, we've seen the massive AI CapEx plans from the large tech companies. And so that's going to help sustain some of the earnings growth over time. And if the consumer can stay healthy financially and can continue to spend on goods and services, then I think we'll likely be in a positive growth scenario. Having said that, there's always downside risk, and one of the things that I'm looking for is the monetization of this AI technology, and will it be enough to offset the capital expenditures that are being deployed right now?
Fascinating stuff. My man, I appreciate you waking up early with us to kick things off on this Friday morning. David Busch, Co-CIO of Trajan Wealth. Take good care. Enjoy your weekend.